The stock market is in turmoil and speculation is running wild. Some blame Trump's policies, arguing that his trade wars and economic strategies have fueled instability. Others see a more complex picture, where global financial shifts, Federal Reserve decisions, and investor sentiment all play crucial roles. But beyond the big headlines, what does this mean for everyday people? Whether you're investing, running a business, or just trying to protect your savings, understanding these economic forces can help you make smarter financial decisions and avoid falling into the panic trap. The media thrives on dramatic headlines, often painting a bleak picture. News outlets warn of an impending recession, pointing fingers at tariffs, interest rate hikes, and economic uncertainty. But financial markets don't move randomly. They respond to policies, global trends, and, most importantly, perception. When investors hear crash, they often react emotionally, triggering sell-offs that amplify the problem. But is the market truly collapsing, or are we witnessing a correction driven by deeper economic forces? Tariffs have played a major role in market volatility. Trump's trade policies, particularly tariffs on Chinese goods, were meant to protect American industries but have instead driven up costs for businesses and consumers. In response, China and other countries have formed new trade alliances to reduce dependence on U.S. markets. This has disrupted supply chains, increased inflationary pressures, and created uncertainty among investors who once saw the U.S. as a financial stronghold. At the same time, the Federal Reserve's monetary policies have added another layer of complexity. Interest rate hikes, aimed at curbing inflation, have made borrowing more expensive, slowing both corporate expansion and consumer spending. This tightening of financial conditions has led to layoffs, shrinking profit margins, and declining stock valuations. Yet despite these concerns, market corrections are inevitable and don't always signal a catastrophic collapse. Beyond policy decisions, the global economy is shifting in ways that go beyond any single administration. Emerging markets are diversifying, looking for trade partnerships outside of the U.S. cryptocurrency, and decentralized finance are becoming viable alternatives to traditional markets. Supply chain disruptions are no longer short-term issues, but long-term structural changes reshaping global commerce. The question isn't just whether Trump's policies are causing a downturn, but whether the U.S. is losing its dominance in the global financial system. Some analysts believe Trump's economic strategies, intentional or not, have accelerated a global rebalancing of power. His tariffs and renegotiated trade deals disrupted long-standing relationships, prompting China, Russia, and the European Union to reduce their reliance on the U.S. The world was already shifting towards a multipolar economy, but Trump's aggressive stance may have sped up the process. This raises a crucial question. Is the market reacting negatively to Trump's policies, or is it adjusting to a new global order? Historically, the U.S. stock market has benefited from America's dominance in trade and finance. If that dominance is weakening, investors must rethink traditional assumptions about long-term stability. The rise of alternative reserve currencies, regional trade agreements, and decentralized finance all suggest that economic power is more distributed than ever before. Despite these seismic shifts, economic cycles are natural. Markets rise and fall, but successful investors don't panic. They adapt. This market turbulence shouldn't be a reason for fear, but an opportunity to reassess investment strategies. Those who understand these forces, rather than reacting to media-fueled panic, will be best positioned to thrive. For individual investors, business owners, and those managing personal savings, the key takeaway is preparation. Diversification is no longer optional. It's essential in a world where trade tensions, geopolitical shifts, and policy changes can rapidly reshape the economy. Instead of relying solely on U.S. stocks, investors should explore emerging markets, commodities, and alternative assets. The goal isn't just protecting wealth, but positioning it where growth is most likely. Another critical factor is the Federal Reserve's role in shaping market sentiment. While Trump criticized the Fed for raising interest rates, monetary policy decisions have consequences that extend beyond any presidency. Years of low interest rates followed by sharp hikes have created ripple effects across corporate debt, housing markets, and consumer spending, which will continue to unfold in the coming months. So where does this leave you? The worst mistake is reacting impulsively to fear-driven narratives. Instead, strategic adaptation is key. Understanding interest rate trends and their impact on different asset classes can help position you ahead of the curve. Staying informed, not just through media reports but by analyzing economic indicators, allows for rational decision-making rather than emotional reactions. And most importantly, resisting the urge to panic sell preserves long-term gains in what is ultimately a cyclical market. Economic uncertainty isn't new. Throughout history, markets have crashed and recovered, reaching new highs. The real challenge isn't predicting downturns, but preparing for them. Whether this is a temporary correction or a larger shift, those who stay informed and adaptable will emerge stronger. The focus shouldn't just be on Trump or any single leader. It should be on understanding the evolving financial landscape and making strategic moves accordingly. At the end of the day, markets are shaped by more than political figures. Economic policies play a role, but so do global trade shifts, technological advancements, and investor psychology. If there's one lesson to take away, it's that adaptability is the most valuable asset. Instead of asking, is the market crashing because of Trump? The better question is, how do we navigate the future of a changing financial world? Bye. What do you think? Is this market turbulence a direct result of policy decisions? Or are we witnessing a deeper economic transformation? More importantly, how can you take advantage of these shifts to secure your financial future? Share your thoughts. We're in this together.